Welcome to Griffonomics.
It is good to be back.
We have a very specific mission today. Usually we take a wide-angle lens to the economy, inflation, housing, the usual suspects. But today we are zooming in.
All the way in.
We are putting a single company under the microscope. But to do that properly, we have to set the scene. It's February 17th, 2026.
Right. And if you've been casually scrolling through your news feed for the last 5 or 10 years, you probably have a mental folder labeled flying cars.
I definitely do.
And inside that folder, you probably have some subfolders, maybe one labeled science fiction, another CGI, and a pretty thick one for vaporware.
Which, for a long time, was the correct filing system. I mean, let's be honest. There was a lot of hype, a lot of very pretty renderings, and very little physics.
Very little actual metal being bent. But the world looks very different today than it did even, say, 2 years ago. We have moved from what I'd call the PowerPoint era of electric aviation.
The PowerPoint era, I like that.
To the certification era. And that's a huge shift. We aren't looking at drawings anymore. We're looking at certified engines. We're looking at moving metal. And as of November 2025, we're looking at public tickers on the stock exchange.
That is the shift. That's the inflection point. And that's why we're doing a deep dive today on beta technologies.
Exactly.
And the reason we are pulling this file now is that they have crossed that chasm. They aren't just a startup in a Vermont hangar anymore. They are a publicly traded aerospace OEM.
Original equipment manufacturer. A real one.
They have a capitalization that would make a mid-sized bank jealous. And this is the key. They are disrupting logistics before they ever put a single passenger in a seat.
That's the cargo-first approach.
Yeah.
And the comparison that keeps coming up in the research notes, and we really need to stress test this today, is the label, the Tesla of the skies.
It's a cliche, usually. Let's face it. Every startup with a battery and a dream claims they're the Tesla of X.
It is. It's almost always a lazy comparison. But with beta, when you peel back the layers, when you look at the vertical integration, the supercharger style infrastructure, the manufacturing philosophy, and the razor and blades economics, the label actually starts to stick.
So it's not just marketing fluff.
No, it's a structural similarity in the actual business model. It's fundamental to how they operate.
So here is our roadmap for the next hour. We are going to trace Beta's transformation from what was essentially a college thesis into a vertically integrated giant. We need to dismantle their stepwise certification strategy.
Which is, in my opinion, the singular reason they might survive the valley of death, while so many others fail.
Then we have to talk about the merchant supplier pivot, specifically that massive billion-dollar deal with Eve Air Mobility that dropped late last year.
That was a shock to the system for a lot of analysts, a real head-turner.
And of course, the money. You have to follow the money. We need to look at the Q3 2025 performance, the burn rate, and what we are calling the liquidity fortress of $1.8 billion.
A liquidity fortress. I like that. It sounds secure. It sounds formidable.
It does, doesn't it? Okay, let's start at the beginning, because the geography here tells you a lot about the philosophy. Beta isn't in Palo Alto. It isn't in Hawthorne.
It's in South Burlington, Vermont.
Which is about as far removed from the Silicon Valley echo chamber as you can possibly get. And that matters. It really does.
It matters immensely. Geography dictates culture. In the Valley, the prevailing ethos, and I'm generalizing here, but it holds true, is move fast and break things.
Sure.
It's fake it till you make it. You sell the vision, you raise the capital on the hype, and then you hire a bunch of brilliant engineers to figure out if the physics is even possible.
Right. It's software thinking applied to hardware, which doesn't always translate.
Especially not when that hardware is flying at 5,000 feet. You can't just push a patch if you have a bug. Beta was founded by Kyle Clark, and his background isn't app development. It's high-voltage power systems and hard engineering.
And the origin story here actually goes back 20 years, which surprised me.
Yeah, this wasn't some sudden pivot during the pandemic. This wasn't a Me Too startup.
No.
2 decades ago, Clark was a senior at Harvard. He wrote his thesis proposing a hybrid electric aircraft. The engineering principles were sound. The aerodynamics, the motor theory, it all worked on paper. But the technology of the time failed him.
It was the batteries, right? Has to be.
It's always the batteries.
Yeah.
20 years ago, the energy density of commercially available cells was, well, dismal. Just not there.
So what would have happened if you tried to build it then?
If you built the plane Clark wanted back then, the battery pack would have been so heavy the aircraft wouldn't have cleared the runway. It literally couldn't lift itself. You needed about 3 times the energy density to make the math work.
So most people would have forced it. They would have tried to build it anyway, raise some money, And failed spectacularly.
Clark didn't. He shelved it. He was patient, he put the plans away, and he waited. He waited for the chemistry to catch up to the physics.
And it did.
And over the last 20 years, thanks largely to the automotive EV revolution, thanks to Tesla and GM and everyone else, battery density has effectively tripled. The math finally started to work.
So when the math worked, he got to work, but he did it with this this Vermont mindset. There is this phrase plastered all over their internal documents. Just show up, just show up. It sounds like a sports slogan, but in the context of aerospace startups, it's a radical rebuke of the industry standard. It's a completely different way of thinking.
How so? What was the standard?
Think about the SPAC boom of 2021. You had all these companies going public via merger that had never flown a plane. Not a full-scale prototype anyway.
Right, they had the CGI videos, the really slick ones.
Beautiful CGI videos. They had celebrity endorsements. They had incredibly aggressive timelines promising thousands of air taxis flying by 2024.
None of which happened, of course.
None of it. Not even close.
Yeah.
EDA inverted that model completely. They stayed private for a long, long time. They built the plane, the ALIA, and they flew it. And they didn't just fly it in circles around their own airfield where they could control the cameras and the narrative.
No, that's the key. They flew it from Vermont to the Paris Air Show.
That is a long flight for an electric plane. I mean, that's not a trivial undertaking.
It's a massive logistical operation. It involves multiple hops, charging, planning. It proves the concept in the real world.
Yeah.
And then they flew it through the Class Bravo airspace over JFK in New York.
Okay, for our listeners who aren't pilots, explain why that matters. Why is flying over JFK a big deal?
JFK is one of the busiest, most complex airspaces in the world. You have heavy jets coming in from Europe, you have domestic traffic, you have strict altitude controls, constant communication.
The ballet of 747s.
Exactly. For an experimental electric aircraft to get clearances to fly through that corridor, speak to the controllers, and navigate that traffic, it sends a message. It says, this isn't a toy. This is a real aircraft that integrates with the existing national airspace system.
It builds a different category of trust. It's not just trust with investors, it's trust with the FAA, with air traffic controllers.
It does. And then they landed it at military bases. They flew to Wright-Patterson. They let generals touch the metal. The just show up ethos means, don't tell me what your plane will do in a press release. Show me what it does do right now in the real world.
There is also a personal element to this culture that I found fascinating. I read that Clark's family, his wife, his kids, they actually work at the facility.
They do. And Clark often talks about having an 85-year lease on the property where they built the factory.
85 years, that's not a typo.
85 years. Think about the timeline he is operating on. This isn't a build-to-flip strategy. He isn't trying to pump the stock and sell to Boeing or Airbus in 2027.
No, this is a generational play.
This is a generational industrial play. He wants to build a legacy manufacturer that employs his grandchildren. That changes how you make decisions every single day. You don't cut corners on safety to hit a quarterly target if your own kids are working on the production line.
It creates a different kind of accountability.
A much deeper kind.
So they have the culture and they have the plane. But let's talk about the problem they are actually solving. Because I think the layperson hears electric plane and they immediately think air taxi.
The first thought, right.
Yeah, I'm going to fly from my condo in downtown Miami to my office. That's the vision that's been sold.
And that is the trap most competitors fell into. They went straight for the urban air mobility or UAM market, moving people over cities, which sounds great, but it's the highest bar for safety, the highest bar for noise, and the absolute highest bar for regulation. It's the hardest version of the problem.
So Beta took a different path. They looked elsewhere.
They looked at the logistics market. They analyzed how packages move around the United States, and they found a massive, glaring inefficiency. The hub and spoke model.
Walk us through that. If I'm shipping a package from Burlington, Vermont to, say, a town 300 miles away in Maine, what happens to that package today?
Okay, so in the current system, if you want that package there tomorrow, it gets picked up, put on a truck, it gets driven to a regional airport. There, it gets loaded onto a feeder plane, like a small Cessna Caravan.
Okay.
That plane flies at 1,200 miles south to a central sorting hub, let's say Louisville, Kentucky for UPS, or Memphis, Tennessee for FedEx.
Wait, so it's flying south to go north?
Precisely. It flies 1,200 miles in the wrong direction, It gets sorted in a massive warehouse with millions of other packages. It gets put on another plane. It flies 1,200 miles back north to a regional airport near the destination in Maine.
And then it gets trucked the final leg.
Then it gets trucked to the final town.
Hmm.
So to move a package 300 miles, you've actually moved it 2,400 miles through the air.
That is just, it's wild. It sounds so wasteful.
It is efficiently inefficient. It works for the big cargo carriers because they need massive volume to fill a Boeing 747 or a 767. But for regional transport, it is slow, it burns a tremendous amount of jet fuel, and it creates a huge amount of unnecessary carbon emissions.
And this is where Beta's hub bypass thesis comes in. This is their solution.
Exactly. Beta's argument is simple. Don't send it to the hub. Because the ALIA aircraft is electric, the operating cost per hour is a fraction of a gas-powered plane. You don't need to fill a 747 to make the economics work.
So you can fly smaller loads more frequently.
You can take a smaller load, say 1,500 pounds of cargo, and fly it point to point, direct.
A direct flight, Burlington to that town in Maine.
300 miles direct, no hub, no massive sorting facility. You cut out the jet fuel entirely. You cut out the noise. It's faster, it's cheaper, and it's greener. That is why companies like UPS and Amazon got interested so early. It allows them to decentralize their networks and get packages to people faster.
Okay, that is the operational theory, and it's a powerful one. Now, I want to get into the nuts and bolts of the business model itself. We titled this The Tesla of the Skies, and you said that label sticks because of vertical integration. For those who don't spend their lives reading manufacturing briefs, define the alternative. What is the standard aerospace model?
The standard model is system integration. If you look at a typical aircraft manufacturer, even the big ones like Boeing or Airbus, they're essentially high-tech assemblers.
They put the pieces together.
They do. They design the airframe, the metal tube, and the wings. But they don't make the engines. They buy them from Rolls-Royce or Pratt & Whitney or GE. They don't make the avionics, the flight computers. They buy them from Honeywell or Garmin. They don't make the landing gear. They buy it from a company like Safran.
So they're like the master chef, but they're buying all the ingredients pre-chopped from different suppliers.
That's a perfect analogy.
Yeah.
And that creates two fundamental problems. One, you're at the mercy of your supplier's timelines. If Honeywell is late with the avionics, your whole production line grinds to a halt.
Your plane is late?
And two, you are paying their margin. Every one of those companies needs to make a profit, so the final cost of your plane is stacked with margins from dozens of other companies.
So Beta looked at that model and said, no, thank you.
They said, we're going to do it the Tesla way. They decided to build the whole stack themselves, in-house.
When you say the whole stack, what does that include? How deep does this go?
Everything that matters for performance. They wind their own electric motors by hand in Vermont. They build their own inverters, which is the electronic brain that tells the motor how to spin, how fast, how much torque. It's a critical component. They assemble their own battery packs from the individual cell level up.
So they're not just buying a big battery box from a supplier.
No, they're buying the raw cells and engineering the pack, the cooling, the management system, everything. And they write their own flight control software. They own the IP.
That sounds incredibly capital intensive, just unbelievably expensive to set up.
It is. It's wildly expensive up front. It burns a lot of cash to set up those manufacturing lines and hire those specialized engineers. But once it is running, it gives them this massive, massive moat. It gives them total control over performance. They can optimize the motor specifically for their airframe, not a generic spec sheet. And crucially, it sets up the razor and blades economic model.
I love this concept. Give us the breakdown. How does it work in aerospace?
It's the classic business school case study, right? You sell the razor handle for cheap or even at a loss, and you make all your money selling the proprietary replacement blades forever.
Right, Gillette.
Gillette. In this case, the razor is the aircraft, the ALIA. They sell that to a customer like UPS or Air New Zealand.
That's a multi-million-dollar razor handle.
It is a very expensive razor.
Yeah.
But the real money, the long-term value, comes from the blades, and the blades are the aftermarket components, specifically the batteries and the motors.
Why do they need replacing? I thought electric motors lasted forever.
They're very reliable, but these are high-utilization assets. If you are a logistics company like UPS, you aren't flying this plane for an hour on the weekends for fun.
No, this is a workhorse.
It's a workhorse. You are flying it 10, 12, 14 hours a day. You are cycling that battery, charging and discharging it constantly. Every single day.
And just like your phone battery gets worse over time, these massive battery packs degrade. The capacity fades.
Exactly. Physics is undefeated. The battery capacity will fade. Management has estimated that a high-utilization customer will need a full battery pack swap roughly once every year to 18 months.
Wow. So over a 20-year lifespan of a single plane.
You might be buying that battery pack 15 times over. And because Beta designed the battery management system and the unique pack architecture, you can't go to a third party and buy a replacement. You have to buy it from Beta.
That's a locked-in revenue stream. And what about the motors?
Electric motors are incredibly reliable, much more so than a piston engine, but they still have bearings and parts that wear out under thousands of hours of heavy load. Beta captures that service and replacement revenue too.
So what's the multiplier?
Get this. Management estimates that the total backlog value, the total lifetime revenue from a single plane sale, is roughly 4 times higher than the initial sticker price of the aircraft.
4 times. That changes the valuation model entirely.
Completely. You aren't just valuing them on plane deliveries, which is a lumpy, one-time thing. You are valuing them on a recurring revenue stream that looks almost like a subscription. It's energy as a service.
And that brings us to the third pillar of the Tesla comparison, the infrastructure, the so-called Supercharger network.
Yeah, and this is the part that surprised me when I first started digging in. They aren't just building chargers for their own factory floor. They're planting them all over North America.
Why?
Yeah.
Why take on that extra cost and complexity?
They realized very early on that if they wanted to sell electric planes for use in, say, rural America, they couldn't rely on the existing grid at small airports. You can't just plug a megawatt-class charger into a normal wall socket at a tiny airfield in upstate New York. The grid can't handle it.
So they had to bring the power with them.
They had to build the charge network.
Yeah. Describe the hardware. This isn't just a fancy wall plug.
No, these are what they call charge cubes. They look like small shipping containers. They are a massive multi-modal charging stations. They contain all the transformers, the power electronics, the battery buffers needed to pull from the grid, even a weak grid, and dump that energy into a plane incredibly fast.
How fast are we talking? What's the charge time?
We're talking 330 kilowatts of continuous power. To give you a reference point, a standard Tesla Supercharger for your car peaks around 250 kilowatts, but it usually tapers down pretty quickly as the battery fills up.
Right.
These cubes hold that high amperage. The result is you can charge the entire aircraft in about 30 to 50 minutes.
Which, not coincidentally, is about how long it takes a ground crew to unload and then reload the cargo for the next flight.
Exactly. It fits the operational tempo of the logistics world perfectly. But the genius move, and this is where they really outsmarted the market, was making these chargers multimodal.
Multimodal meaning it charges more than just their planes.
Yes. The cubes have a long cord and a standard CCS plug, the same one you find on an electric Ford F-150 Lightning or a Rivian delivery van.
Oh, that's smart.
So while the plane is landing and taxiing, the airport ground crew can plug in the electric forklift or the last-mile delivery truck that's waiting. It makes the charger useful 24/7, not just for the 30 minutes the plane is there.
That makes the airport manager very happy. It turns a piece of niche infrastructure into a utility for their whole operation.
It makes everyone happy. And this is the kicker. They're opening it up to their competitors.
Now, that's the part that seems counterintuitive. Why would they do that? If you have the only gas stations on the highway, why let Joby or Archer use them?
Because if you own the gas station, you don't care if a Ford or a Chevy or a Toyota pulls up. You just sell the electrons.
You make money either way.
You make money either way. It turns what would be a cost center, building out infrastructure, into a new profit center. They have over 80 active sites across North America right now, and they recently went global.
The Middle East deal, I saw that.
Yes. Late 2025, they signed a major deal with Abu Dhabi airports. They've already commissioned the system at Al Bateen Executive Airport, and they are rolling it out to the massive Zayed International in 2026.
So Beta is effectively becoming the default infrastructure provider for the UAE's entire advanced air mobility network.
It's a land grab, a brilliant one. They are securing the prime real estate and the grid connections before anyone else even has a certified plane. Even if their own aircraft is delayed by a year, their chargers are on the ground, generating revenue.
Speaking of selling to competitors, that leads us perfectly into the merchant supplier strategy. Because late last year, December 2025, we got a press release that really confused some casual observers.
The Eve deal.
The Eve deal. Beta agreed to sell their electric motors to Eve Air Mobility.
This was a watershed moment for the industry. This was the moment the market realized that Beta had arguably already won the propulsion war.
Explain who Eve is for those who don't follow this space closely.
Eve Air Mobility is not some garage startup. They are a spin-off backed by Embraer.
The Brazilian aerospace giant.
Exactly. Embraer makes the regional jets that you fly on all the time for short-haul flights. They know how to build and certify planes. They have thousands of world-class engineers.
And yet this company with all that expertise decided not to build their own motor for their new electric plane.
Exactly. For a company like Embraer to look at Beta's motor, test it, analyze it, and then say, you know what? We can't build it better than they can, and we certainly can't build it cheaper than they can, so we're just going to buy it.
Yeah.
That is a massive third-party validation.
It's the ultimate compliment.
It proves that Beta has a significant, durable tech lead. It's like Ford deciding in the middle of the EV transition to just put a Tesla motor in the F-150 Lightning because it's just that much better.
That is the perfect analogy. And the numbers on this deal are just staggering.
They are. The deal represents a potential $1 billion in revenue over 10 years.
$1 billion from a direct competitor.
Correct. And here is the breakdown of that billion, which is so important. It's roughly 60% hardware sales, so selling the actual motors and inverters, and 40% recurring aftermarket services and support.
There is that razor and blades model again. It's not just on their own planes, it's on their competitors' planes too.
It's everywhere in their business. And think about the risk mitigation here. Beta is effectively hedging their own bet. Let's say, for whatever reason, the Beta aircraft market is slow to develop, but Eve's aircraft is a huge hit, and they sell 1,000 of them.
Beta still makes a ton of money.
Beta still wins. It's the Intel inside strategy for aviation.
That's it. You don't care which laptop the customer buys, Dell, HP, Lenovo, as long as your chip is inside. Beta wants to be the propulsion system for the entire electric aviation industry.
Precisely. And they aren't stopping at aviation, which is another fascinating layer here. You mentioned they have contracts with General Dynamics.
Yeah, for undersea applications. That one threw me for a loop.
It's a brilliant diversification play. They are developing propulsion for classified undersea marine applications.
Submarines.
Submarines, underwater drones, that sort of thing. It sounds weird, right? Going from the clouds to the ocean floor. But the physics is the same. A submarine needs a motor that is incredibly power dense because space is at an absolute premium.
Sure.
It needs to be incredibly efficient because battery life underwater is everything. And it needs to be quiet because, well, it's a submarine. Stealth is the name of the game.
And Beta's electric motors, designed for quiet, efficient flight, fit that profile perfectly.
They do. It's pure diversification. It proves that their core IP, the motor technology itself, has immense value far beyond just their own airplane. It's platform technology.
This brings us to the plane itself, or I should say planes, plural, because this is the part that always confuses people, and it's the absolute core of their stepwise certification strategy.
This is, in my opinion, the smartest strategic move Kyle Clark ever made. This is what separates them from the entire pack.
So most companies in the space, Joby, Archer, Lilium in Europe, they are all trying to build a VTOL aircraft from day one, vertical takeoff and landing.
Right. That is the flying car dream. Taking off from a rooftop in Manhattan, landing in a parking lot in the suburbs. No runway needed. It's the ultimate prize.
But certifying a commercial VTOL aircraft with the FAA is, from what I understand, a regulatory nightmare. It is playing the game on hard mode.
The hardest mode. Because it's new. Helicopters exist, sure, but these aren't helicopters. They use distributed electric propulsion, they have tilting rotors, they have completely new failure modes that the FAA has never seen before.
So the FAA has to basically write the rule book while they are testing the planes.
Exactly. And that involves creating new pilot training requirements, new air traffic control procedures. It creates massive uncertainty in the timeline. Your whole business plan can be wrecked by a single regulatory delay.
So Beta looked at that mountain and decided not to climb it all at once. They split the problem in half.
They did. They cleverly designed two versions of the ALI platform. Step one is the CTOL that's conventional takeoff and landing.
The simple version.
The simple version. This version, the CX300, has wheels. It needs a runway. It doesn't hover. It takes off and lands exactly like a Cessna or a Pilatus that's been flying for 50 years.
And because it flies like a normal plane, the FAA knows exactly how to certify it. There's a process.
There's a very clear process. It falls under the existing Part 23 regulations. The FAA has been certifying Part 23 planes for decades. There is no mystery there. Beta is targeting certification for this conventional version for late 2026 or early 2027.
And they are well on their way. They're already building conforming articles, right? The final test planes.
Yes, they are building the planes that will be used for the final exams with the FAA.
Yeah.
And they're doing engine testing for credit with the FAA right now, which is a first in the industry. They're getting ahead.
So they get the conventional plane certified. They start selling it to UPS or to United Therapeutics for organ transport. They start generating real significant revenue. Then what?
Then comes step 2, the VTOL version, the A250. That version follows the conventional plane by about 12 to 18 months. So you're looking at late 2027, early 2028 for that one.
But why does doing the runway plane first help the vertical plane? How do they connect?
Because of the commonality. This is the beautiful part. The two planes share 80% of the same parts.
80%.
The fuselage is the exact same carbon fiber shell. The wings are the same. The batteries are identical. The main pusher motor at the back is the same. The flight control software is largely the same.
So when they certify the conventional plane, they are effectively certifying 80% of the vertical plane at the same time.
You got it. They are de-risking the complex project by completing the simple project first. And they're generating revenue while they do it. While their competitors are burning cash, waiting for the FAA to finalize the VTOL rules, Beta can be out there flying cargo on existing runways, earning money, training pilots, and gathering millions of hours of real-world battery data.
And operational proof. You mentioned earlier they have flown over 100,000 nautical miles.
100,000 miles. That is a staggering number for this stage of electric aviation. Most prototypes do short hops around an airfield. Beta is doing cross-country flights.
And testing in harsh environments.
All over. They're testing in the bitter cold of Norway with the helicopter operator Bristow to see how the batteries handle freezing temperatures. They're flying in the brutal heat of the UAE to test thermal management.
They even did that mission carrying donated packages across multiple states.
Just to prove the utility. They couldn't legally charge for the shipping because they aren't certified for commercial ops yet, but they proved that the plane can fit into a real logistics network seamlessly. It was a brilliant marketing and engineering exercise.
Okay, we have covered the commercial side pretty thoroughly, but there is another major player in the room, a big one with very deep pockets.
A military.
The military, and specifically the partnership with GE Aerospace.
This is a critical piece of the puzzle and another huge validation point. In September of 2025, GE Aerospace made a $300 million equity investment in Beta.
That is a serious vote of confidence from a legacy player. I mean, GE makes the jet engines that power the world. For them to bet on Beta is significant.
It is. But they didn't just invest cash. They collaborated on a specific product, the MV250.
The M stands for military, I assume, and this one is different. It's a hybrid.
It is. And this is where the physics gets really interesting. The military has different mission requirements than UPS. UPS flies predictable routes between known charging stations. The military needs to fly into contested areas like the island chains in the South China Sea where there are no charging cubes waiting for them.
They need range and flexibility.
They need range above all else. So they essentially strapped a jet engine to it.
You're kidding?
Not really. They took the ALIA airframe and integrated a GE turbogenerator. It's a small, highly efficient jet engine that doesn't power the propellers directly. It just burns jet fuel to keep the batteries charged in flight. It's a range extender.
So why not just use a helicopter at that point? The military has plenty of those.
Efficiency. It all comes down to one key metric, lift-over-drag ratio. It's a measure of how well an aircraft glides, how aerodynamic it is.
Okay.
A standard helicopter has a lift-over-drag ratio of about 4. It has to fight the air constantly just to stay up. It's like it's beating the air into submission.
That sounds about right. They're not exactly graceful.
No. The ALIA, because it has big, efficient wings and is incredibly aerodynamic, has a lift-over-drag ratio of about 15 to 17.
So it is roughly 4 times more efficient at moving through the air than a helicopter.
4 times, which means it can go further and faster on the same amount of fuel. And this is key for the military application. It can be autonomous, no pilot on board.
That is the contested logistics play you hear the Pentagon talking about.
This is the exact hardware for that mission. If you need to resupply a Marine base on a small island 500 miles away and the airspace is dangerous, you don't want to risk a flight crew in a slow, loud helicopter. You send the robot. It's quiet, it has a low heat signature, and if it gets shot down, you only lost metal, not people.
It's a game changer for that kind of mission. Okay, let's get into the nitty-gritty, the financials. We are looking at the Q3 2025 report, which is the latest we have. What do the numbers tell us?
They tell us a story of a company that is spending a lot of money to grow, which is expected, but is also starting to generate real meaningful revenue much earlier than its peers.
Okay, what's the top line?
Revenue for Q3 2025 was $8.9 million.
That doesn't sound like a lot for a multi-billion-dollar company.
On its own, no, it's not huge. But context is everything. It beat the Wall Street consensus estimate by over 30%. The analysts expected less. And that beat was driven largely by those early motor deliveries to Eve and other partners.
So the merchant supplier business is already paying off.
It's already showing up in the numbers, but the growth is what really matters. That revenue was up 190% year over year. That's the trajectory investors are looking at.
But they are losing money, right? A lot of money.
Oh, absolutely. And they will be for a while. The operating loss was about $80 million for the quarter. The adjusted EBITDA for the full year 2025 is expected to be a loss of around $295 million to $325 million.
So they are burning furniture to keep the house warm, so to speak.
Well, they are building a massive factory and certifying a revolutionary new aircraft. That is capital destruction by definition until you can start deliveries. Free cash flow was negative $278 million over the trailing 12 months.
That's a big number.
It's a huge number, but, and this is the biggest but, in the entire story, they have that liquidity fortress we talked about.
Let's open the vault. What is in there? How much cash do they have?
At the end of Q3, just before the IPO, they had $687.6 million in cash on hand. Then they had a successful IPO in November 2025, which netted them roughly another $1.1 billion after fees.
So, quick math. You add those together and you get nearly $1.8 billion in total liquidity.
A little under $1.8 billion. And that's why management can confidently claim this is the longest runway in the industry.
That is a very good pun for an aerospace company.
It is, but it's also a critical survival mechanism. In this industry, cash is oxygen. If you run out of cash before you get certified, you die. Period. Or you get bought for pennies on the dollar by a competitor.
So that $1.8 billion means that even if certification slips by 6 months or even a year, which happens
all the time.
Beta doesn't die. They don't have to go out and do a desperate, dilutive fundraising at a bad valuation. They can weather the storm.
It gives them immense strategic flexibility.
Speaking of valuations and stock movements, did you see that weird blip in February of this year? The so-called false flag?
The Amazon surge, yes. This was a fascinating lesson in market psychology and how narratives drive these stocks. In February 2026, Beta stock jumped about 17% in a single day.
And the news was?
The news that circulated was that Amazon had a 5.3% stake in the company.
But wait a minute, didn't Amazon invest years ago? That's not new information.
Exactly. Amazon invested way back in 2021 through their Climate Pledge Fund. It was old news. It was disclosed plainly in the S-1 prospectus document when they went public. Anyone who did their homework knew about it.
So the market just missed it.
For some reason, the algorithms or the retail traders or whoever treated it like breaking news and bid the stock up aggressively. It just goes to show you how volatile these narrative stocks can be.
It reminds us that the market doesn't always read the footnotes.
It rarely does. But underlying that short-term volatility is a very real backlog of orders. They reported $3.5 billion in deposit-backed orders.
Now, deposit-backed can mean a lot of things in this industry. How real are those orders?
That's the right question to ask.
Right.
It's a mix. They have orders for 891 aircraft on the books. But we need to be careful here and break that down. Only 289 of those are what we would call firm orders, with significant non-refundable deposits.
And the rest?
The rest are options. They're less binding agreements. So if Beta doesn't deliver on time, or if the customer's strategy changes, those options could just evaporate. That revenue isn't guaranteed until the metal is delivered and the final check clears.
Which brings us neatly to the dangers, the risks. Because this all sounds great, $1.8 billion in the bank, the Vermont charm, the military deals, but this is still a high-risk, high-reward play.
It is incredibly high risk. Let's not sugarcoat it. They are burning nearly $180 million every 9 months. That $1.8 billion is a fortress, but if you burn it fast enough, any fortress can fall. And scaling manufacturing is notoriously difficult.
The production hell that Elon Musk talks about.
Exactly. Going from building one perfect prototype by hand to building 5 planes a week on an assembly line is a completely different challenge. It's where many companies fail.
And the timeline is everything. The whole plan hinges on that certification date.
Certification delays are the rule, not the exception, in aerospace. If the FAA Part 23 certification for the CTOL plane slips past 2027 and into 2028, the pressure ratchets up immediately. Investors get nervous, the stock drops, it gets harder to hire top talent, it can become a negative spiral.
And the competition isn't sleeping. We mentioned Eve, but what about Joby and Archer? How do they stack up?
Joby Aviation is the other giant in the space. But their model is totally different. They are pursuing the Uber model. They want to operate the service themselves.
So they have to build the plane, build the consumer app, hire the pilots, get an air carrier certificate, and run the whole airline.
Exactly. It's a much higher capital cost and a much higher set of regulatory hurdles because you are flying passengers over cities from day one.
Oh.
But if they pull it off, the total addressable market is arguably much, much bigger.
It's a bigger swing. And Archer.
Archer is taking the outsourced manufacturing route. They partnered with Stellantis, the car company that owns Jeep and Chrysler, to build their planes.
As that lowers their upfront capital costs.
It does. But it probably means lower margins for Archer in the long run because they have to pay Stellantis. And they have less control over that lucrative aftermarket revenue stream we talked about. They're giving away the blades to keep the razor.
So Beta's niche, their key differentiator, is really cargo first.
Cargo first. It's a wedge into the market. Boxes don't complain if the landing is a little bumpy. Boxes don't sue you if you are 10 minutes late. It allows them to enter the market with lower safety thresholds and less public scrutiny than passenger flight requires.
That makes a ton of sense. But there is also the risk of dilution for the current shareholders, right?
Yes, that's always a factor. Those warrants issued to GE as part of their investment, that's future dilution. The 20 million or so stock options outstanding for employees, that's dilution. If you are buying the stock today, you have to accept you'll be getting a slightly smaller slice of the pie over time.
It's why analysts are calling it a high-conviction compounder.
Which is Wall Street speak for. This is going to be a bumpy, volatile ride, but we think it's a massive winner in the long run if you can stomach it.
Okay, let's wrap this up. We have unpacked a lot of information. Let's try to summarize the bull case for Beta. Why do we like this story?
The bull case is, first and foremost, the Stepwise strategy. It's pragmatic. They aren't trying to boil the ocean. They are building a simple plane than a complex one. Second, they have brilliantly diversified their revenue. They are selling motors to competitors, charging cars, charging other planes, and working for the military.
So they have multiple ways to win.
Multiple ways to win. And third, they have that $1.8 billion cash buffer to survive the inevitable mistakes and delays.
And the bear case. Why might this all go wrong?
The bear case is the burn rate. It's just a raw fact. It's the absolute reliance on a certification that hasn't happened yet. And it's the volatility of the market. If the narrative turns against EVs or electric flight in general, Beta gets dragged down with it, regardless of their own execution.
Here is my final thought, and it's something I've been mulling over since we started talking about the Chargers and the Eve deal. Beta is positioning itself not just as a plane manufacturer. They are the gas station. They are the engine supplier for the whole industry.
Right.
So even if the Aliere plane itself is a total flop, let's just imagine a world where it fails to meet performance specs. God forbid could they still win just by powering everyone else.
That is the ultimate hedge, and it's the most compelling part of the bull case for me. If Eve and Archer and 5 other companies all succeed using Beta motors and Beta chargers, Beta becomes a massive, profitable company without ever selling a single plane of their own. They were selling the picks and shovels in the new gold rush.
Risk defined, portfolio protected.
Couldn't have said it better myself. It's a fascinating case study.
Thanks for listening to Griffonomics. We'll catch you on the next deep dive.